And a wonderful day to you. This is Owen McCafferty again, through the kindness of Professional Fusion, offering some ideas and thoughts. And the title of our discussion today is going to be debt. Debt is the second leg of a three-leg stool of assets, liabilities, and equity. Debt and liabilities are basically synonymous. The word liability is taken from the Latin ligare, which means to bind, or to restrict, or to limit. And that's exactly what debt does. Debt restricts. The reason why I'm raising it right now is that people are getting into a rather debtful situation. It's not uncommon. We saw it in many instances in the past, saw it again in the Carter years, saw it in 1997, when we had a crash of the old dot-coms, if people can remember those. Saw it, of course, in 2001, and the economic difficulties that result from that. Of course, who could forget 2008 to 2015, when we had one of the most severe recessions that I can remember. And we're back into it, folks, and the debt that I see is occurring on the balance sheets of my accrual-based clients, which is usually most of them. And might I just throw an ad in for you maintaining your books and records on an accrual method so that you don't become victim to the theory that things are okay when in fact they are not. But getting back to the issue of liquidity from an economic standpoint, I am seeing a trending that's occurring in the population as a whole. From a personal standpoint, the debt that is growing in credit cards and in secured second mortgages for tapping into needed things to basically supplement the earnings. The wages and the profits are not keeping pace with the inflationary costs. And in addition to the inflationary costs, there's the changes in price. Now, let me distinguish. Inflation is the classic definition of less and less goods and services chasing more dollars. And we saw that with the government printing money. And no matter how you cut it, the government caused the inflation. It wasn't some magical activity of greedy individuals. It was we printed too darn much money, and we didn't have a population that could keep up with the productivity. If you remember the early 80s to about 1990, we had the boomers coming on board, educated people who were basically products of the post-depression mentality of working hard. They basically worked us out of a major economic difficulty. I don't see the same devotion, nor the educational system for the younger groups that are coming on board now. And in fact, they're having difficulty finding positions because the areas of study that they devoted were not based in economic reality, but rather the perception of what was either trending or recommended by professors who were trying to do nothing more than stay employed. And you're seeing some reversal of that right now. Give you an example in the accounting profession. Back in the late 70s, early 80s, the debate was we need to have more years of college education before you could become a CPA. Well, guess what? It has made the designation so expensive and so unattainable that we have a massive shortage of CPAs today. So lo and behold, the accounting leadership is coming back from their meetings and saying, we have to change things. And basically they have to go back to that which was. Well, there's a whole group of us that warned them in the first place. If you make something so unattainable, you will not have an adequate market for it. So that kind of theory today can be found in terms of the way that we're dealing with debt. We're incurring more and more debt to supplement a lack of productivity that will cause the inflationary cycle to diminish. Bring also to bear, and it's not all just the government's fault, it's also greed. Now, there's a lot of things that people in government say that I will disagree with, but this is one that I do agree. And that is that there has been greed in the past on the part of various forms of individuals in government, but also in the economic sector. People have gouged price. They've raised things under the guise of lack of supply or labor costs going up, when in fact the price increases, and a component of that is the inflation, but the other part is just pure corporate greed. And I do agree with that. I saw it again in the automotive industry when in the COVID-19 period, when there was a lack of supply, dealers were making vehicles so unaffordable that it put many people upside down. And they found out that the liability that was owed was far in excess of the fair market asset of the asset that was acquired. So what are you going to do in terms of debt and how debt is affected? Debt is basically a way to make the pain go away for not having adequate capital to maintain your standard of living. So the first thing is pay down on your credit card debt. It's incestuous. You incur more credit card debt, you have a higher amount of interest, which means that it becomes even more difficult to pay down on your debt, and you're still using that credit card to supplement the lack of earnings that you have to maintain a lifestyle, not necessarily a luxurious lifestyle, but to maintain a lifestyle in the same form that you have in the past. It's going to take years to dig out of that one. In fact, with over $35 trillion of debt, it's going to take a massive amount of time. So personally, try to keep your credit card debt down. Be careful about buying new fancy things like homes or cars, because you, again, most probably will be borrowing the money if you can secure a loan. A lot of the banks are saying no, because they also see the trending that's occurring. From a practice standpoint, salesmen will be coming around, patting you on the back, telling you, you really do need to acquire this because it's the cutting edge in terms of your profession for the newest technology. Well, patient base may not support that. First of all, if patients are not employed, especially in the human area where you have indemnification by third parties for insurance, they're not going to be able to secure authorization for a lot of procedures that all of that very expensive equipment was designed to provide. In veterinary medicine, you'll see that people just can't afford those exhaustive procedures that heretofore may have been festival priced. I can think of procedures that would be charged out at thousands of dollars for effort on the part of the surgeon that would be 45 minutes. Those procedures just may not be capable of being authorized by the client on behalf of their pet charges. So be careful about buying new things. Also be careful about the easy terms. Do a cash flow. And what I recommend is bring your accountant in. You know, there's something known as break-even analysis that takes into consideration fixed costs, variable costs, and profit, and then sets a purchase price based on estimate of volume. Start to do some of those things. It doesn't take much. Bring your accountant in, not to necessarily do it, but to teach you how to do it, so that in the future you can make your own decisions quickly. So watch out for debt. Debt is a way that binds you as the Latin term implies, and restricts what you can do in the future. So for that, this is Owen McCafferty, just trying to provide you with some ideas and thoughts, look at historical perspective, and go back to the future. So hope to see you in some future videos. Again, thank you for listening.